Welcome to today's Daily Report Market Analysis videos with me, Richard Perry, Market Analyst at Hantech on Tuesday the 25th of February. There's been a mild risk rally today, nothing too significant. I mean, in terms of how markets have gone, massive sell-off yesterday, huge sell-off. Equity markets across the board were just significantly lower. The S&P 500 3.35% lower. Dow Jones 3.5% low. So we've seen that the fears of this coronavirus and the spread of COVID-19 has really started to impact through markets. Volatility levels are spiking higher. Look at that VIX, which is at the highest since January 2019. So 13, 14-month highs there. And it has been a real impact through bond yields as well. You've seen the Treasury, the 10-year Treasury yield, actually at a low of 135 yesterday. 131.20 was the July 2016 all-time low. So we're not too far away from there. And initially this morning we had a bit of a rebound on Treasury yields, but that rebound has just sort of dissipated as the European session has got going, and subsequently you're seeing equities falling back again. Initially a little bit of a rebound we were seeing this morning, but not so much now. And it's that would suggest that there is continued fear, really. There's nothing really that was driving a recovery. Maybe the fact that some of these international stories of the spread of COVID-19 hadn't sort of significantly expanded, but overnight we've seen that a little bit of a technical rally has basically just been seen as another chance to sell, and it does seem as though that is the case. And what we've seen is gold, which reached 1688 yesterday, that was the high since January 2013, unwound back around about 55 bucks, but again that has actually rebounded again today. So on an intraday basis, I should add, and I'll tell you the technical implications of that in a bit, but some significant moves that we have seen in the past 24 hours or so, and it doesn't seem as though that the selling pressure is done quite yet. Just as a sort of a little chart to interest you is the correlation between the Treasury yield on the 10-year and also gold. This is inverted Treasury yield and gold. Look at the how closely knit those two lines are moving. So certainly how safe havens are moving in this spread of COVID-19 is correlated, significantly correlated between Treasuries and the gold price. So, takes me on to data points for today. We've got a bit of a US focus this afternoon, nothing really this morning, so we're looking out for the Case-Shiller House Price Index at, 2 o'clock, and expected to see that improving actually to 2.8%. The consumer confidence expected to improve from the Conference Board's consumer confidence at 3 o'clock, expected to improve to 132. From 131.6, so holding up very well still on that consumer confidence number. You can see that with the blue line here, so that would be still very high, but yeah, you've got to wonder whether that is going to be the case ongoing if this coronavirus continues to spread. And we're also looking out for the Richmond Fed composite index, which is expected to drop back to 10 from 20 last month. Watch out for this evening. We've got Richard Clarida, this evening UK time that is, Richard Clarida, who is a board member of the FOMC. He's speaking, he leans slightly dovish, and he could he be sort of a signal for a shift in sentiment from the Federal Reserve tonight. So that takes me on to my chart of the day, which is the New Zealand dollar. Now, what we saw yesterday was a pretty decent performance actually from the New Zealand dollar, and it actually held the support of Friday's low. 63 big figure held as a support and rebounded. It was sort of playing around with the possibility of building a hammer candlestick pattern, but didn't quite make it into the close and just dropped back a slight amount today. But it's interesting that that support around 63 figure, I think that could be something to keep an eye on, because there is the prospect here of a positive divergence on the RSI. We initially this morning, as when I came in, you saw that the Kiwi dollar was actually trading higher, and it seemed as though the momentum indicators were bottoming out. But as this risk rally has just dissipated again, it doesn't seem as though that the Kiwi is ready to recover quite yet. You can see that here on the hourly chart. and we've seen that rebound just falling over slightly, but there is this resistance at 63.60 area, this resistance of the last couple of sessions. That's a near-term level to watch out for. That could form a small base pattern, but given the fact that the market has started to fall back in the last hour or so, that recovery doesn't look all that great. But watching out for hourly RSI. If that can hold on to 40, then the prospect of a recovery is still on the table. But I think if that goes back under 40 towards 30, then you're looking at the retest of the lows again. That low coming in around 63 big figure, as I said earlier. So we have got this this Kiwi which remains under pressure. It looked, as I said yesterday afternoon, when the dollar was starting to fall back, it looked as though the Kiwi was starting to form a basis of a potential recovery, but essentially it would be a recovery within a selling phase, still within a bear trend of the last 7 or so weeks, 7-8 weeks, and it would be a rally that you'd likely to see being used as the next selling opportunity, because yeah, the Kiwi doesn't look as though it's a currency yet ready to recover on a sustainable basis, and rallies would be seen as a chance to sell. But below 63 figure, you'd open the downside once more towards 62 figure. So with that in mind, I wish you good luck in your trading. Click here to subscribe to our analysis videos and go to our website to sign up for our webinars.